Welcome to this video. I'm Milind Date and I'm the expert tutor for the AFM examination. In this video, I will unpack the dividend theories propagated by experts and the dividend policies followed by organizations in the real world. Please remember, in the AFM paper, you already studied the three main functions of financial management. That is investing decision, financing decision, and the distribution decision. The three decision areas are pretty much interdependent, interlinked together. But in this video, I'll focus primarily on the distribution decision. Especially, it's a trade-off decision between the reinvesting the profits back into the business and distributing them to the shareholders of the organization. Before I move forward, please note that this is not a teaching video, but this will give you some important tips in preparing yourself for the AFM examination. So let's see, how is this topic included in the AFM syllabus? The focus of AFM syllabus is certainly on the dividend policy as a part of financial strategy formulation within the context of multinationals. So there is a specific reference to multinational environment which provides you the context for this topic so far as AFM exam is concerned. And then there are two parts of the syllabus areas where this is covered, namely section A2 and section A6 of the syllabus. And this is explained in the study guide very, very clearly. For example, the area A2 talks about recommendation, appropriate distribution and retention policy. Now, this means that a student can expect certain piece of information or pieces of information about the organizations, its profitability over a period of time, its context within the industry in which it operates, and the way in which it has been distributing dividends among the shareholders over a period of time. Now, based on this data and, of course, some other information, you may be required by the examiner to recommend an appropriate policy. And the second part of this syllabus area, it talks about dividend policies that are adopted generally in the multinational organizations, where the syllabus area further expands and lets you learn about dividend capacity of the organization, how to determine the dividend capacity, and then based on that, how to decide the policy of the organization. So please carefully look at the learning objectives, as these will set the context for your learning. You'll need to assess as to how the distribution decision taken by companies and how the investors react to any changes in the distribution policies of the organization. Whether the dividends influence shareholders' decisions within the set scenario in pursuit of their objectives of wealth maximization. Because that's the important question that experts offered to answer through various approaches. And these approaches revolve around the effect of dividend on share prices. And this brings us to knowing about some of the important dividend theories. So what sort of theoretical framework did the experts come up with? Let us have a quick look at various dividend theories. According to the Modigliani-Miller theory, in a perfect market, shareholders are not bothered whether the company pays dividend or not, so long as, of course, it keeps generating good income streams and good profitability. So, because according to the shareholders are worried about the wealth generation, wealth creation. So they're indifferent to the fact of whether the company is paying dividend or the wealth generation is happening through increase in the market price of the share. So according to them, for determination of the value of company's share or the shareholders' wealth, dividend decision is irrelevant, not relevant at all. But this, of course, presupposes that the market is perfect, the investors are rational, and in the world, there are no transaction costs, no taxes, and information is freely available to all the investors. And they say, okay, investors are concerned about increasing wealth. Where it comes from, they are indifferent towards it. So whether it comes from a stream of dividend or it comes from capital growth. Let's assume that company doesn't pay dividend. AMM argue that shareholders will then manufacture their own dividend by selling a portion of their shareholding, or maybe borrowing money using the shares that they hold as a security. The assumption, of course, here is that if no dividends are paid by the company, then the retained earnings are reinvested in the projects which yield positive net present values. And the rate at which these returns are generated are rather equivalent of the required rate of return by the shareholders. And this is the AFM irrelevance argument. On the other extreme, some of the experts say, no, dividends are directly linked to creation of value of share, creation of wealth. And they do believe that there is a strong relationship between dividend payments and the share price, where they say share price is a function of stream of dividend payments. In short, the price of the share today is equal to the present value of future expected dividends. And it is here, therefore, the dividend policy of the organizations is an important factor that can influence share prices in the market. For example, the Gordon model, with or without growth, of course, will help us to establish such a relationship. Of course, in the examination, you will be given the Gordon model formula, so you don't have to learn it by heart. Don't rote learn it, understand it. So learn how to estimate certain numbers in the formula, and one such number is a growth rate. You know, growth rates may not be directly given to you in the AFM examination. So you may have to determine it based on certain assumption criteria, like, for example, future expected dividends could be based on the geometric mean of the past trends, an average, but a geometric average, not an arithmetical average, or it's expected that the retained dividends, retained profits rather, would be reinvested to get positive net present values equal to the required rate of return. So in that sense, the growth rate can be determined by the percentage of retention times percentage of the rate of return that the projects are likely to get to the company. So there is a relationship that Gordon's formula tells us exists between the dividend payments and the share price of the organization. A third approach, which is totally different from the first and the second, could be termed as a residual theory. Remember, this can be closely linked to the pecking order theory that you would have learned during your AFM examination. The approach suggests that companies at first would decide to reinvest the profits back into the business, and then, or if there are no investment opportunities further available, then only the profits could be distributed by way of the dividend. And this is where, as I said, retained earnings is considered as one of the cheapest form of internally generated funds. And therefore, retained earnings should be, according to this approach, the first source of finance used to fund the projects. So this is, the dividend theoretical framework, most of which you will have to bring it in the form of your carried forward knowledge from the AFM examination. But in the examination of AFM as well, you may have to bring this point in order to substantiate your answers. Because in the real world, the things could be completely different. And that is where the dividend policy framed by the organizations will have to be setting the context for you. So let's discuss what in the real world, apart from the theoretical framework that we studied, what are the dividend policy determinants? Now, of course, for the company to be able to pay out dividends, it has to have liquidity, no doubt about it. But when you decide a certain portion of profits to be distributed as dividend, please remember it's not a one-off decision. It's a policy that the company can set to be followed over a certain period of time. And when you decide to pay dividends based on a set policy, it can send out certain signals to the market. And if you then suddenly change your policy, what kind of change, what kind of signal you are giving it out in the market, and therefore, how would the market price of the share get affected? For example, would a reduced dividend mean that the company is conserving cash for future uncertainties, for covering future uncertainties? Or would it be possible that the company is retaining cash for the purpose of reinvesting in profitable opportunities? So it's a kind of a signal that company is providing to the market. If you think in terms of investors' preferences, many of them may have the approach that, okay, let me have dividends, let me have current cash against future uncertainties. Because you never know whether the reinvested cash would really yield the required rate of return or not. And there could be a lot of risks to which the new projects may be exposed to. So investors would tend to prefer bird in hand rather than two in bush. So investor preferences and composition of your investors, composition of your shareholding pattern would be a deciding factor when you're talking about setting your dividend policy. The third could be called as a clientele effect. Well, when the company is listed on a stock market and the shares are widely held, the different groups of shareholders may have different objectives in mind. And they would invest in the shares to suit their needs. For example, if you talk in terms of a pension fund, they would invest in anticipation of a regular dividend payments. because that is what they would be distributing to their own clients, a steady income. If many of the shareholders are within the high tax bracket, and if taxes are, if dividends are taxed at the highest rate, the investors may prefer companies paying low rates of dividend but high capital gains, which may be taxed at a lower rate. Now, understanding wise, this may sound simpler, but in real world, analyzing the entire shareholder base like this and then basing our dividend policy on that is really very, very difficult. But no doubt, it's a very valid determinant of companies' dividend policy. As I said earlier, company must be always liquid in terms of availability of cash to distribute dividends. If sometimes the company reduces its dividend, in that case, the signaling effect could be, oh, is the company running out of cash? Is the liquidity at jeopardy? So that's something which investors would want to know. Unless, of course, they are explained by the company through its official communication with the shareholders. Another factor that's important for determining your dividend policy is the restrictive covenants, which often come to you through the lending arrangements. Lenders may restrict dividend payments either in the initial periods of time, or they may set up certain limits beyond which the company may not be permitted to, pay dividends out to the shareholders. Now, why is this something that you need to learn? There could be questions around the real world scenario, or maybe a certain data on a number of companies given to you, and you may be asked by the examiner to comment upon the policies of the organization in light of these determinants. So what different types of policies related to dividend payments the company adopt? And remember, this is not a theory. This is based on empirical evidence that the companies have been exhibiting in their real life scenarios. Certain organizations may be paying constant dividends. The amount of dividend per share in terms of dollar dividends remains same. It has no linkage with the profitability of the company. Even if it varies from year to year, the company will maintain constant dividend per share. It's a policy. What effect it will have, what signaling it will have, would be a matter of discussion, would be a matter of study, and information related to that may be available to you in the case scenario given. Another way in which a policy can be described is a constant growth dividend model, which means once the company starts paying dividend, the company will keep on growing the dividend at a constant rate. And this is where a couple of minutes ago I had spoken about, the estimation of growth, either as a geometric mean or by applying the formula, growth is equal to retained profit percentage times the required rate of return percentage. So companies may adopt a consistent growth model so far as dividend payouts are concerned. Now, you will have to look at the context given to you in the examination and then probably asked to comment upon whether this type of a policy is appropriate, is suitable for this organization or not. Another type of dividend policy could be constant payout ratio. Dividend as a percentage of earnings of the company. A company, for example, may decide it will distribute 30% or 40% of earnings. So in case there are no earnings, if there are losses in a particular year, no dividend, of course, needs to be paid. So that's something which, is called constant payout. Of course, the amount of dividend will keep differing every year depending on the level of profits that the company would achieve. And obviously, as in case of startups or very high growth companies in their initial stages, companies may follow a policy like no dividends. You would have seen when the company like Apple was formed, first few years, there were no dividends paid out to shareholders, but now it's a completely different story. Naturally though, because company in its initial phase of very high growth needs the profits to be reinvested back into profitable projects so that the future income, future wealth generation can be secured for the shareholders. So these four types of dividend policies are quite commonly seen in the real world scenarios. But these all relate to one specific way of paying dividends, and that is payment of cash dividends to the shareholders. Apart from cash dividends, there are different ways of distributing profits, which could also be important for you in the AFM examination. For example, the company may decide to buy back its own shares and release the entire money to the shareholders who offer their shares for buyback under a buyback scheme. Company could make special dividend payments, or company could resort to scrip dividends. That is, instead of paying cash as a part of dividend, the company may offer additional shares to the shareholders, but of course at a market value. Buyback is like a permanent return of capital to the shareholders. The effect, of course, it will have is to reduce the number of shares outstanding, and naturally it will further lead to increase in the ratios like earning per share or return on equity. Naturally, the denominator, which is the number of shares, will reduce. Any share buyback scheme may tend to signal that the company does generate surplus cash and that the company may not be having sufficient positive NPV projects to invest in. Now, where it could happen, just think, I mean, it could happen in case of a company which has a very matured business model where the technology is not going to change much, and maybe in the entire life cycle of the product or the sector within which the company operates is at the moment towards the last stages. So companies may choose to buy back shares in such scenarios. Special dividends, like one-time payouts, huge, or maybe a 50-year special dividend, centenary special dividend. And they specify that this is one-time special payment. So there are no expectations about getting such huge amounts of money on the part of shareholders in future. And scrip dividends, as I said, shareholders here get a choice whether to receive the dividend in cash or shares in lieu of that. So when it comes to theoretical framework and the real world dividend policies, if you learn the concepts that I have just narrated to you, it would provide you with some kind of learning that will help you in answering questions on this particular syllabus area in the AFM exam. So what is the way in which this syllabus area may be questioned by the examiner? Let us quickly have a look at it. Possible questions on this syllabus area, based on, of course, my analysis of the past exam questions, would be like determination of estimated dividend capacity of the company, whether it's a domestic company or a multinational company. Dividend capacity, of course, is an expression of the free cash flows for equity. So from other chapters of this examination, you could learn the ways in which you can calculate free cash flows for equity, free cash flows for firm, FCFE or FCFF, as they say. But dividend capacity is necessarily equivalent to the free cash flow for equity. There may be a discussion that is required on the existing dividend policy that the company is following and commenting on possible effects on the shareholders' value. So here you can first find out what is the policy, whether it's constant payout, constant dividend, growing dividend, or no dividend, and then back it up with supporting calculations from the data provided to you in the scenario, and then support it with what kind of theoretical framework you can observe there. Another way in which the examiner can ask the question is comparing and contrasting the dividend policies of certain number of companies. They may say, hey, here is an investment company which wants to invest in company alpha, beta, theta, like that. And these are the dividend payments. So these are the earnings of alpha, beta, and theta for last 5 years or so. You need to observe from that data what kind of policy, dividend policy the company is following, and then you may have to comment upon that, comparing those policies, and then advise based on the objectives of this investment company as to where the company should invest. And you may have to, for that purpose, do certain quick ratio calculations like earning per share, price to earning ratio, growth rates in the dividend, and the such simpler ratios. So questions that can be set are not very complex unless, of course, you have not learned it at all. So make sure that you use all possible ACCA resources to learn this particular topic. And here are some suggested learning resources for you. Study Hub. This topic is explained in chapter number 12, ACCA AFM Study Hub. There's a practice platform where you can find past exam questions which you need to keep on attempting. And there are examiner reports where you can find the observations, especially about the weaknesses of the students. So, my dear friends, what have we seen in this AFM Topic Explainer video? We talked about dividend theory and dividend policy. We started by saying dividend distribution decision continues to be the area of important area, of course, a key area of financial management strategy. And of course, in the real world, changes in the dividend policies can influence the shareholders' decisions whether to stay invested or to sell, because it may affect directly or indirectly their wealth. Dividends, according to empirical evidence, are seen to affect the value of shares and therefore could be used to estimate the value of shares in the events of acquisition. So mergers and acquisitions is an important area where this concept can be used. So that's it in this video from me. I wish you all the very best for your learning on AFM syllabus areas. Thank you very much.